Welcome back to our channel. If you're new here, don't forget to hit that subscribe button and the notification bell so you never miss out on our latest financial tips and tricks. Today, we're diving into a topic that affects millions of people every day: mortgages. Whether you're a first-time homebuyer or looking to refinance, this video will break down everything you need to know about mortgages in a simple and detailed way. Let's get started. We'll break down today's content into 7 different chapters. Chapter 1: What is a mortgage? Chapter 2: How do mortgages work? Chapter 3: Types of mortgages. Chapter 4: Key mortgage terms. Chapter 5: How to get the best mortgage rate. Chapter 6: Common mistakes to avoid. And Chapter 7: The mortgage process timeline. Now, let's begin. Chapter 1: What is a mortgage? So, what exactly is a mortgage? A mortgage is a loan from a bank or financial institution that helps you buy a home. The home you purchase acts as collateral, meaning if you can't make the payments, the lender can take the property to recover their money. In simpler terms, it's a way for people who don't have all the money up front to buy a home by borrowing it and paying it back over time with interest. Typically, mortgages come in terms of 15, 20, or 30 years, but other terms might be available depending on the lender. Chapter 2: How do mortgages work? Let's break down how a mortgage works. When you apply for a mortgage, the lender will look at several factors to determine if you qualify, such as your credit score, income, employment history, and debt-to-income ratio. These factors help the lender assess your ability to repay the loan. Here's a quick overview of the key steps involved. Number 1: pre-approval. You get an estimate from a lender on how much you can borrow. This involves providing documentation of your income, assets, and debts. A pre-approval letter shows sellers that you are a serious buyer with financing ready. Number 2: house hunting. You find the home you want to buy. It's crucial to have a clear budget and a list of must-haves versus nice-to-haves in a home. Number 3: loan application. You formally apply for the mortgage. This step involves filling out a detailed application form and providing additional financial documents as requested by the lender. Number 4: underwriting. The lender reviews your financial information to approve the loan. This includes verifying your employment, income, and credit history. The underwriter ensures that you meet the lender's criteria. Number 5: closing. You sign the mortgage documents, pay closing costs, and get the keys to your new home. Closing costs can include fees for the loan origination, appraisal, title search, and more. It's important to review all documents carefully before signing. Chapter 3: Types of mortgages. There are several types of mortgages to choose from, each with its own pros and cons. Let's go over the most common ones. Fixed rate mortgage. The interest rate stays the same for the entire term of the loan. This means your monthly payments remain consistent, making it easier to budget. Fixed-rate mortgages are ideal for those who plan to stay in their home for a long time. Adjustable rate mortgage, also called ARM. The interest rate can change periodically, typically after an initial fixed-rate period. For example, a 5/1 ARM mortgage has a fixed rate for the first 5 years, then adjusts annually. This means your monthly payments can go up or down. Adjustable rate mortgages may be suitable for those who plan to move or refinance before the adjustment period begins. FHA loans, insured by the Federal Housing Administration, these loans are designed for first-time homebuyers or those with less than perfect credit. They require a lower down payment, often as low as 3.5%, and have more lenient credit requirements. VA loans, available to veterans and active duty military personnel. These loans are guaranteed by the Department of Veterans Affairs and often require no down payment and no private mortgage insurance. They also offer competitive interest rates. Jumbo loans. These are for homes that exceed the limits set by the Federal Housing Finance Agency. They usually require a higher credit score and a larger down payment. Jumbo loans are used for luxury homes or properties in highly competitive real estate markets. Choosing the right type of mortgage depends on your financial situation, how long you plan to stay in the home, and your risk tolerance. Be sure to discuss your options with a financial advisor or mortgage professional to find the best fit for your needs. Chapter 4. Key Mortgage Terms. Now let's go over some key mortgage terms you'll need to understand. Principal is the amount of money you borrow. This is the actual loan amount, excluding interest. Interest is the cost of borrowing the principal, usually expressed as an annual percentage rate, also referred to as APR. The interest rate affects your monthly payment and the total cost of the loan. Amortization is the process of paying off the loan over time through regular payments. With each payment, you reduce both the principal and the interest owed. In the early years of a mortgage, most of your payment goes towards interest, but over time, more goes towards reducing the principal. Escrow is an account used to pay property taxes and insurance premiums. The lender collects escrow payments along with your mortgage payment and uses them to pay these bills on your behalf. Private mortgage insurance is an insurance that protects the lender if you default on the loan. It's typically required if your down payment is less than 20%. It can be canceled once you've built enough equity in your home. Understanding these terms will help you make informed decisions and better understand your mortgage documents. Knowing the difference between principal and interest, for example, can help you see how your payments are structured and how much your loan will cost over time. Chapter 5. How to get the best mortgage rate. Getting the best mortgage rate can save you thousands of dollars over the life of your loan. Here are some tips to help you secure a lower rate. Improve your credit score. Pay your bills on time, reduce your debt, and check your credit report for errors. A higher credit score typically qualifies you for lower interest rates. Number 2, save for a larger down payment. The more you can put down, the less risky you appear to lenders, which can help you secure a better rate. Aim for at least 20% if possible to avoid paying for private mortgage insurance. Number 3, compare rates from multiple lenders. Shop around and get quotes from different lenders to find the best rate. Don't just settle for the first offer. Different lenders can offer different terms. Number 4, consider buying points. Paying for points up front can reduce your interest rate over the life of the loan. Each point typically costs 1% of the loan amount and can lower your rate by about 0.25%. Number 5, lock in your rate. Once you find a good rate, lock it in to protect yourself from rate increases. Rate locks usually last for 30 to 60 days, so make sure you can close within that period. Remember, a small difference in your interest rate can have a big impact on your monthly payment and the total amount you pay over the life of the loan. For instance, a 0.5% difference on a $200,000 loan can save you about $60 a month, which adds up to $21,000 over a 30-year mortgage. Chapter 6. Common mortgage mistakes to avoid. Here are 4 common mortgage mistakes to avoid. Number 1, not getting pre-approved. This can make it harder to know how much you can afford and weaken your negotiating position. Pre-approval shows sellers that you are a serious buyer with financing ready. Number 2, ignoring additional costs. Remember to budget for property taxes, insurance, maintenance, and closing costs. These can add up and affect your overall budget. Number 3, choosing the wrong loan term. A shorter term means higher monthly payments, but less interest paid over time, while a longer term means lower monthly payments, but more interest paid. Choose a term that fits your financial goals and budget. Number 4, overextending yourself. Don't borrow more than you can comfortably afford. Consider your lifestyle and future financial goals. Make sure your mortgage payment fits comfortably within your budget, accounting for all other expenses and potential future changes in income or expenses. Avoiding these mistakes will help you stay on track and ensure that your home is a blessing, not a burden. For example, failing to account for all costs can lead to financial strain down the line, making it difficult to keep up with payments and maintain your home. Chapter 7. The Mortgage Process Timeline. Here's a rough timeline of the mortgage process. Pre-approval usually takes 1 to 2 weeks. You should get pre-approved to know your budget. This step involves gathering financial documents, such as pay stubs, tax returns, and bank statements. House hunting can take from a couple of weeks to a couple of months, depending on the market and your specific criteria. Loan application usually takes 1 week. This is when you submit your formal application. Be prepared to provide detailed information about your finances and the property you wish to purchase. Underwriting usually takes between 2 and 3 weeks. In this step, the lender reviews your application. This process involves a thorough examination of your financial health and may include additional requests for documentation. The last step is closing, and it usually takes 1 to 2 weeks. This is when you'll finalize the loan and close on the home. During closing, you'll sign all necessary documents, pay closing costs, and receive the keys to your new home. This is also when the lender disperses the loan funds to the seller. While these timelines can vary, this gives you an idea of what to expect. Patience and preparation are key. Delays can occur, so it's important to stay in close communication with your lender and real estate agent throughout the process. And that's a wrap on our comprehensive guide to mortgages. We hope this video has helped demystify the mortgage process and given you the confidence to make informed decisions about your home purchase. If you have any questions or need further clarification, feel free to leave a comment below. And don't forget to like this video, share it with anyone who might find it helpful, and subscribe to our channel for more great content. Thanks for watching, and we'll see you in the next video.